Welcome to the Mint, live from ZTN headquarters in Harare, Zimbabwe. Our main stories today: Zimbabwe Finance Minister, he rebases the economy. He says gross domestic product will actually decline by at least -2%. And today, we look at comparison of some prices in Zimbabwe to that of South Africa. Don't go away. This and much more on the Mint, coming right up. Now, as usual, we look close to home at the Zimbabwe Stock Exchange. Let's see how the Zimbabwe Stock Exchange traded on Friday. For a price at the time equivalent to 21.4 billion rand, it would create a leading Southern Hemisphere retailer and become one of the top 10 global department store operators by buying iconic Australian brand David Jones. On Thursday, the South African company said it had written down the value of David Jones again because of economic headwinds and the accelerating structural changes affecting the Australian retail sector, as well as the performance of the business, which has fallen short of expectations. At current exchange rates, that means Woolworths has now recorded on its books a loss of little under 12 billion rand, or well over half its initial huge investment. Woolworths paid a premium of more than 25% for David Jones 5 years ago in a deal that was enthusiastically accepted by the Target's board. At the time, Woolworths said it had already identified initiatives that would deliver synergies of at least 1.4 billion rand per year within 5 years. Instead, the losses racked up because of write-downs in David Jones, saw Woolworths report its first losses in over a decade, even though it continued to trade profitably in South Africa. Now, a quick look at U.S. markets. Now, stock futures were lower Friday as investors digested news of an additional 10% tariff on Chinese imports from the U.S. ahead of a key jobs data. Dow Jones Industrial Average futures fell 58 points, including a loss of 60 points at the open. S&P 500 and NASDAQ 100 futures also pointed to a lower opening. In a series of tweets on Thursday, President Donald Trump said the 10% charge will be imposed on $300 billion worth of Chinese goods. The levy will take effect starting September the 1st. The move breaks a truce in the long-running trade war between the world's two largest economies, with investors fearful it could further disrupt global supply chains. China's foreign ministry pushed back against Trump's latest tariff threat on Friday morning, reportedly saying the world's largest economy should give up its illusions, shoulder some responsibility, and come back to the right track on resolving the trade war. Trump's tariff threat came as a surprise to financial markets in the previous session, in large part because negotiators for the two sides had just met earlier this week in China. Trump is also scheduled to make a trade announcement on the European Union later on Friday. Now, on the data front, investors will be closely monitoring the latest readings of non-farm payrolls. That was done late on Friday evening. Average hourly wages and unemployment rate figures for July will be released at the same time. The jobs report comes after the Federal Reserve Bank cut rates earlier this week by 25 basis points. Now, European markets. European stocks plunged on Friday after U.S. President Donald Trump said he would slap a 10% tariff on the remaining $300 billion worth of Chinese imports from next month. In fact, this additional tariff will put tariffs on every single import that China makes into America. The discussion is, who pays for these tariffs? Is it China or is it American consumers? Economists believe it's American consumers. And as you can see, the stocks 600 FTSE was down as well, 2.34, as well as the CAC 3.57%, and the DAX in France down 3.11. In fact, the European stock 600 tumbled 2% on Friday, basic resources and auto stocks falling 4.1% and 3.6% respectively, as all sectors and major bourses traded sharply in the red. Investors are rushing into safe haven assets after President Trump, in a tweet on Thursday, jettisoned a trade truce between the world's two largest economies while talks over a resolution are ongoing. Now, in the UK, Britain's pro-European Liberal Democrats have beaten the governing Conservatives in a special by-election, striking a major blow to Prime Minister Boris Johnson and reducing his already narrow working majority in Parliament to just one seat. Liberal Democrat candidate Jane Dodds won in the Brecon and Rodenshire region of Wales, defeating Conservative candidate Chris Davis, who had previously held the seat. The Conservative loss follows Johnson's pledge to take Britain out of the European Union by October the 31st without a deal if necessary, and will likely be seized on by pro-European lawmakers as apparent proof that voters do not back his hardline stance. The European Central Bank is ready to cut rates and embark on a fresh round of bond purchases this autumn, a move that the ECB hopes will fend off fears of economic uncertainty and a global economic slowdown. The bank's president, Mario Draghi, made clear that all measures available to the ECB will be used as the export-driven European economy is experiencing a severe slowdown due to the German economy, the fourth largest in the world, posting dismal figures in recent months. A brewing conflict between Brussels and Italy over the latter's budgetary policy and the threat of a disorderly Brexit. Draghi explicitly referred to the ECB's intention to go beyond the Euro 2.6 trillion bond-buying program that ended in December 2018 as a way to boost business confidence. He also mentioned, however, the need for government action in the form of fiscal expansion for more financially stable members of the Eurozone. The ECB does not expect deflation or recession in 2019, but Draghi made clear that interest rates are likely to be cut. Now, Asian stocks dropped on Friday after a surprise tariff announcement. Now, remember, I keep on telling you the effects of economies and how stock markets are interrelated. And, of course, President Trump's tweets announcing that from September the 1st he would impose additional tariffs on the rest of China's imports into China was taken by some surprise by the market. And, of course, it escalated trade tensions between Washington and Beijing. U.S. President Donald Trump said Thursday that the U.S. is putting 10% tariffs on another $300 billion worth of Chinese goods, as I said, starting September the 1st. In the wake of the unexpected move, mainland Chinese stocks tumbled on the day. The Shanghai Composite fell 1.41%, the Shenzhen Component slipped 1.42%, and the Shenzhen Composite shed 1.484%. Over in Hong Kong, of course, at the moment, Hong Kong is actually shut down, really, because protesters have blocked the main streets into the central business district, not allowing people to go to work. In fact, Hong Kong, we're going to keep an eye on that, because the Chinese government, we're waiting to see how the Chinese government is going to react to the latest protests. And in fact, over the weekend, police fired tear gas to disperse protesters in Hong Kong. The Hang Seng Index declined 2.35% to close at 26,918.58. Now, responding to Trump's latest salvo, China's foreign ministry said Friday that the country does not want a trade war with the U.S., but is unafraid of fighting one. Trump's surprise tariff announcement came after the two countries concluded a round of trade talks this week, with negotiations set to resume in Washington in early September. Now, shares of Apple suppliers in Asia took a hit on Friday afternoon trade following the fall in the Cupertino-based tech giant stock Thursday stateside. In Japan, component supplier Murata Manufacturing saw its stock drop 1.62%, while South Korea's LG Display fell 5.56%. Hong Kong lens manufacturer Sunny Optical plunged 7.77%. And Taiwanese chip maker Taiwan Semiconductor Manufacturing Company, one of the largest makers of chips in the world, also fell 1.95%, while Hon Hai Precision Industry, commonly known as Foxconn, declined 3.08%. Now, Apple has been among the companies caught in the crossfire of the ongoing US-China trade war, as it assembles iPhones and other products in China, leaving it at the risk of being impacted by any tariffs placed on Chinese exports. A quick look at African currencies. Against the US dollar, the Chinese offshore yuan fell to its weakest in 2.5 years on Friday and was close to a record low, again because of President Donald Trump's threat to impose new tariffs on Chinese imports. The surprise threat, raising the prospect of all imports into the United States from China being hit with tariffs, also sent investors scrambling for the safe haven yen, lifting it to a 16-month high against the dollar. 10% tariff will be imposed on 300 billion worth of Chinese goods. I'm going to keep on repeating this on September the 1st, after U.S. negotiators reported no progress during trade negotiations in Shanghai, with the U.S. president saying China had failed to live up to promises made in previous talks. The Swiss franc, another currency viewed as a safe haven, reached a two-year high of 1.0940 against the euro in mid-morning trade on Friday. The dollar did not benefit from the scramble for safety. Its index was down 0.1% at 98.242, falling away from 26-month highs hit on Thursday before news of the tariff threat. Sterling was hovering around the 30-month low it reached on Thursday, with the British currency last trading unchanged at 1.2126 against the dollar and at 91.50 pence against the euro. Non-farm payrolls are due in the United States later on Friday. Economists forecast a decrease in the number of jobs added to the economy to 164,000 in July from 224,000 in June. Quick look at commodities around the world. On the metals market, gold prices fell nearly 1% on Friday as investors booked profits after U.S. President Donald Trump's fresh salvo in the year-long trade spat with China increased demand for the safe haven metal in the previous session. Spot gold was down 0.5% after hitting a two-week high of 1,446.10 earlier in the session. The metal has risen about 1.4% so far this week, heading for a third weekly gain out of 4. Now, energy. Oil prices rose around 2% on Friday, regaining ground after their biggest falls in years on President U.S. Donald Trump's vow to impose more tariffs on Chinese imports. The move, due to take effect on September the 1st, would intensify a trade war between the world's top two economies and crude consumers that has disrupted global supply chains and roiled financial markets. Brent crude slumped more than 7% on Thursday, the steepest drop in more than 7 years. Of course, today that was the main story in the market. It was the imposition of an additional 10% tariffs on 300 billion more products coming in to China. Well, that's it for what's happening in the economy. Now, in the market. In the economy, coming up after the breather, Zimbabwe Finance Minister announces that gross domestic product of Zimbabwe will contract at least -2%. And in fact, we have it on good authority at a breakfast meeting this morning. He said -3%. And of course, we're going to look at some comparisons between prices of some commodities in Zimbabwe compared to their prices in Rand in South Africa. Please, your comments on our Facebook page, Zim Papers TV Network, and of course, our website, ztn.co.zw. Please keep them coming in and give us your comments on the stories that we have here on The Mint and on other future stories that you may think The Mint may have a look at. Why not? If you want your story to come on The Mint, why not drop us a line? Welcome back to the Mint, and of course it is a Monday, and as you all know by now, it is my favorite day. I always tell you, Monday's a day you can take stock and figure out what you're going to do, particularly in business, finance, and economics for the week ahead. And of course, at the end of the week, we have a holiday coming up Monday and Tuesday, Heroes Weekend. But don't worry, the Mint will be aired on Monday and Tuesday, so don't miss your favorite business show. Please pass your comments on our Facebook page, Zim Papers TV Network, and of course, our website, ztn.co.zw. We want to hear from you, so please keep your comments coming in. Now then, according to Newswire, they said that we wanted to look at what was the good, the bad, and the meh, and the ugly, so to speak. Anyway, the good in the Finance Minister Ntuli Ngube's midterm fiscal policy review and supplementary budget was, put it this way, 806.6 million H1 fiscal surplus, 196 million current account surplus, and of course $4.2 billion for infrastructure. We've got 2.5 billion, for infrastructure. We've also got removal of import duties on solar batteries and 700 tax-free thresholds for you and me. That's the good. Now, what about the meh, the kind of okay? Well, some economic ZESA tariffs. Of course, the minister did announce ZESA tariff increases. However, they are below what ZESA asked for and below what other players in the industry in Southern Africa charge. The average charge for ZESA is around 9 cents per kilowatt per hour. We are still, for consumers, down at 3 cents. So there's still a subsidy there. And of course, staggered approach to administrative price increases in order to manage pass-through effects on inflation. Now, what about the ugly? Well, as I said earlier in our main story, of course, the minister said minus 2.1% gross domestic product contraction, 4.56 billion deficit in 2019. Another year of command agriculture, at least $1 billion. $500 million going to be spent on new cars, 64 million for Air Zimbabwe, and gold output to decline 20% to 28 tons. Coal production collapsed 40% to 2 million tons in 2019. And here's the big one. Kariba power output to be curtailed at 358 megawatts in the half year 2019, second half of 2019, after ZESA has used up 74% of its annual water allocation in 6 months. That's according to Newswire. Now then, Hippo Valley. Listed sugar processing concern Hippo Valley Estates Limited says complexities around its financial results has necessitated a further extension of a grace period assigned to it by the Zimbabwe Stock Exchange. Hippo Valley Estates is a subsidiary of South African headquartered sugar manufacturer Tongaat Hulett. The ZSC had previously given Hippo Valley the leeway to publish its financial results by July the 31st, 2019, from the initial publication deadline of June the 30th, 2019. And now another extension has been sought and granted. Allegations of financial misappropriation at Tongaat Hulett Limited has forced Zimbabwean subsidiary Hippo Valley Estates Limited to postpone publication of its FY 2019 results. The parent company is facing an accounting scandal back in South Africa, which resulted in the suspension of its securities on the Johannesburg Stock Exchange, JSE, in June. The group share was suspended following the JSE's announcement on May the 31st that the company would have to restate its equity by between 3.5 and 4.5 billion for its 2019 year. That's in rand. Hippo Valley Estates has said, although it is not aware of any financial impropriety by the company, it has decided to carry out its own internal investigations, as it is likely to be impacted by investigations on its parent company. Now, our main story, Zimbabwe gross domestic product to contract at least minus 2%. Zimbabwe's economy is expected to shrink this year due to a drought, foreign currency shortages, and severe power cuts, Finance Minister Ntuli Ngube said in his monetary policy statement on Wednesday. Prices of basic goods and services have more than doubled since June, when the government renamed the RTGS currency as the Zimbabwe dollar, which has been sliding in value, and widespread shortages, including power, fuel, dollars, and bread. That has stirred memories among an increasing impoverished population of an economic chaos a decade ago, when rampant money printing fueled hyperinflation and forced the country to abandon its currency. The minister said the revised 2019 GDP growth is expected to be negative. That's what he told Parliament last week.
Conditions which badly affected a number of sectors, particularly the agricultural and power generation coupled with inflationary pressures, foreign currency shortages prevailing, and limited external financial support, there have been major drawbacks, Mr. Speaker said, on growth stimulation in the first half of 2019. In view of these headwinds, the revised 2019 GDP growth is expected to be negative.
The twin fiscal and current account. Would stop issuing out year-on-year inflation data. This is anticipated to help with comparisons. Now, have a look at what the Finance Minister said about that, which is quite interesting.
The change in currency regime from multi-currency to Zimbabwe dollar has definitely impacted Given this transition, Zimstats will defer the for a period of 12 months to February 2020. So this will ensure that we compare like with like in terms of currency regime. I'll repeat. They will stop publishing year-on-year inflation because last year inflation was on a US dollar regime. This year inflation post-February 20th is on RTGS/Zim dollar regime. Therefore, you are not comparing like with like. So the best way to handle inflation is to run on a month-to-month inflation for a full 12 months to February 2020.
Now, this instance of not portraying or not giving out year-on-year inflation was also adopted again in 2019 when we changed the currency regime. Zimstat resorted to only gazetting month-on-month inflation. Year-on-year inflation publication will resume after February 2020 alongside the month-on-month inflation publication. Interestingly, the mid-year review provided an new collections of $0.85 plus, and of course
was
6 2018. Development Bank, $702 million. European Investment Bank, $309 million. And other multinational Laterals, $74 million. That's what comes to that debt. And it's critical that we bring this to the party. So the minister does have an issue in terms of repaying debt to multilateral lenders. Total bilateral debt amounted to $5.5 billion US, with Paris Club creditors accounting for $3.5 billion of that. Domestic debt in 2018, Zimbabwe witnessed a dramatic increase in domestic debt fed by fiscal deficits of above $2 billion, primarily financed by the issuance of treasury bills and central bank overdraft. However, for the period between January and June 2019, significant fiscal adjustments culminated in domestic debt containment. The high-impact measures included zero recourse to central bank financing, including the overdraft, restructuring over the overdraft facility, cash advances and treasury bills held by RBZ into long-term marketable instruments, a stop to any treasury bill issuance for Zamco, that's the company that's looking after non-performing loans in Zimbabwe, and issuance of treasury bills only for budgeted expenditures and honouring of TB's maturity. But here's the great number. Current account balances. For the first time since the adoption of the multi-currency regime in 2019, the current account registered a surplus in the first quarter of 2019. Surplus was $196 million registered in the first quarter, compared to a deficit of $491 million for the same period in 2018. And of course, Reserve Bank monetary targeting. The minister said from now onwards, the Reserve Bank has adopted a monetary targeting framework to curtail the rise in money supply. Look, the minister, as we said on the Mint last week, did quite well. He tried to find a balancing act. Sure, he was criticized here and there. However, with the tools he had, he appears to at least come through. And as well, he did say in his budget that the Treasury will continue keeping an eye on shocks in the economy so as to take immediate action so that the TSP and his fiscal plan is not derailed. So we're going to keep an eye on that for you, of course, because following the TSP is obviously vital for Zimbabwe's economy in the short, medium and long term. Now, Tanzania has signed an agreement with China to construct this longest bridge on lake waters in East Africa to facilitate transport and trade with neighboring countries. The government linked the contract with two Chinese contractors, the China Civil Engineering Construction Group and China Railway 15th Bureau Group Company Limited, for execution of the Kigongo-Busisi Bridge. The bridge plan dates back to 1977 and failed to pick up, though, because donors refused to finance its construction. Gaita Regional Commissioner Robert Gabriel acknowledged that construction of the bridge was a dream of the father of the nation, the late Julius Nyerere. The 3.2 kilometer bridge on Lake Victoria will connect Kigongo and Busisi areas in Mwanza region. The bridge will reduce transport time and facilitate trade amongst the East African countries. Currently, vehicles spend up to 3 hours to cross to either side of the lake by using ferry, and about 45 minutes to reach the other side. Now, on the 24th of June, Zimbabwe banned the use of the rand, the US dollar and other currencies as legal tender in the country. This brought to an end nearly a decade where those currencies were used as legal payment. The Bureau of the Change exchange rate is currently between 9.5 to 9.7 for every US dollar, or roughly 0.7 cents for every rand. On the Zimbabwean street market, the exchange rate is $10 for every US dollar. Business Insider South Africa compared prices of everyday household goods in stores in Harare, Zimbabwe's capital city, to prices in South Africa. Now have a look at these. Huggies gold nappies. There's 52 in a packet. That's roughly in Zimbabwe 373 rand 27. In South Africa, look at that, 229 rand 99. Now, if you look at baby soft ply, you can see that 89 Zim dollars, which is 128.56 rand, 47 rand in South Africa. And of course, Bokomo Weetabix, 450 grams, is 54.98 rand equivalent in Zimbabwe, 23 rand 99 in South Africa. And of course, baked beans, we all like our baked beans. Look at the price in South Africa compared to ours, 23.99 in South Africa compared to 37.27 here at home. And Nivea body lotion, it's 84 Zimbabwe dollars, equivalent to 120.70 rand. Almost more than half the cost, 52 rand 99 in South Africa. This is one of the issues that we see about price distortions between our largest trading partner, South Africa, and Zimbabwe. And this is one of the problems that we have as consumers into understanding why is there such a huge price increase. I mean, have a look at baby soft ply, 2-ply toilet paper. Look at the difference in cost. It's just under almost 90 rand. Can you see that? That's a lot of a difference in terms of prices. And this is one of the major reasons why we look at prices in South Africa and in Zimbabwe and trying to understand why is that cost build-up? What is making that cost build-up so expensive? And that is what's obviously hurting consumers in their pockets. Anyway, our final story, back in the 70s, a guy called Gary Dahl had the idea of selling rocks as pets. Yes, I've said it right. The unbelievable part is not the idea itself. Anyone can have a weird thought. But the fact that he went on with his plan and it paid off big time, in fact. He actually became a millionaire for selling, rocks. That's what he did. Anyway, I hope that put a smile on your face on this beautiful Monday morning. As I say, a great day. Please keep your comments coming in on Zim Papers TV Network Facebook page and, of course, our website, ztn.co.zw. Well, that's it for the Mint today. I, of course, will see you tomorrow morning as usual. 10 a.m. live on ZTN headquarters. Here from ZTN headquarters, I'll be live on the Mint. I'm Andy Hodges. You have a great day. Be safe. And I'll see you tomorrow. Goodbye.